presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello, everyone, and welcome to the Compak Market Wrap Weekly Update for January the 3rd, 2024. I hope all of you had a wonderful Christmas, and I would like to wish all of you a very happy, healthy, and prosperous 2024. I'm looking forward to it after the wonderful year that we had in 2023 as far as the markets were concerned. First of all, I want to remind all of you to go to the compak.com/media page so you can go and get all of the information that we put out on a regular basis. You can get the weekly podcast, download the mobile app for Market Wrap, register for upcoming events, subscribe to the iTunes podcast, and receive the weekly Market Minute. That's the weekly sort of one-pager that I put out every week that you can get, and it's all free. All you have to do is go to compak.com/media. And don't forget to subscribe to this one so whenever I do an update, you will be notified. Let's start with the week. Looking back last week, the market was up 0.34%. Quarter, it's up 11.69%, the S&P. And for the year, 26.29%. What a great year in the markets. No one expected it. Everybody was looking for a recession, except me. You heard me in 2022. That's nearly a year, 2 years ago, when I said, I don't think there's a recession because the unemployment rate is so low. The Dow was up 0.81. The Russell was down 0.28. Year to date, it's up a quarter. It's up 14%. Year to date, 16.93. So it lagged the S&P. The small caps did by about 10%. As you know, I said that I believe it could be the best sector for 2024. As I put out on the podcast, the two best sectors that I expect in 2024, and you can listen to the podcast as I did that a couple of weeks ago. Looking at the rest of the markets, technology was the best for the year, but we're seeing that it is not the best in the past week. As interest rates come down, utilities, consumer staples, healthcare, real estate, financials, those are the ones that have done the best. Energy last week was down about 1.4%, but it is up quite a bit. It's up at $2.25 today on the sort of the heating up of the Middle East. That's really what we're seeing. There is now some that it could spread a little bit, the war, as long as it stays in Gaza. As I said, in October, it really does not affect the markets, but we are starting to see some problems in the Gulf of Aden and the Red Sea. We could see some shipment problems there, so we will see. At this point, I don't think it is, but it is starting to look like it could become a problem, but not yet. Looking at oil from where we were last year and where we are now, we're down about $10 a barrel, or about $8 a barrel from where we were a year ago. Gasoline prices, on the other hand, are still up. $3.09 was the average gallon. Now it's $3.12, even though oil is down. It takes days for gasoline prices to go up, but it takes a long time for them to come down. You're looking at the bond market. Yield 1 week was up slightly quarter to date. But we're starting to see yields come down. As I will take a look at the chart, we're starting to see a little bounce here in yields, but I think it's going to be short-lived. Looking at the weekly asset classes last year, a U.S. large cap, as I said, was up nearly 26%. 27% was the best one out there. China has been suffering. This is 2023. This is 2022. I believe China has got a lot of economic problems, especially their real estate sector, which will take time for it to really figure itself out. We did get Case-Shiller home prices. They're starting to move up. As I said, interest rates as they come down. I believe real estate, which has already gone up a lot, but I think it will pick up a little bit because of the shortage of inventory. Builders have not built a lot of homes, and there's a lot of existing home sales out there, and that is the problem, that we just don't have inventory. Once the inventory catches up, then I think prices could come back down, but the builders have been very, very cautious. Initial claims rose slightly to 218,000. Pending home sales remain flat month over month. We did get the the JOLT report today, or the job openings report, showed a slight decline, slightly lower than expected, but it shows that there's 1.4 jobs now available for everyone looking for a job. So that number continues to come down. We are going to get the non-farm payrolls, that is the employment report, on Friday, and that should give us an idea of how much slowing we're seeing in the job market. Looking at the technicals, S&P, it looks like hit a third wave high. We're starting to see a fourth wave pullback. First support is around 46.98. We made a low today of 47.04, so we got very close to this. If we do break this, then I think we could come down to somewhere around this area right here, which is around 4,600. So 4,700 is going to be a critical support area. But we did get to 47.93 as a high, not quite the 48.08 to 49.23 high that I had target, the Fibonacci projection that I had. But I still think that was a short term. We're getting a pullback here. We're extremely overbought. But 4,700 is a critical area that I'm watching right now. On a long-term basis, 48.18, the all-time high, is the first target. Support here on the weekly charts, each one of these lines right here that you see are 1 week of trading, those vertical lines. So we're starting to see 48.18. The long-term target from this projects to 5,000 to 51.50, but that might be some time away from where we are right now. So we'll have to wait and see. First, we are going to get this small pullback. We'll see how far we pull back. And if we break 4,700, then we could go a little bit lower, so we'll have to watch that. NASDAQ, on the other hand, seems to have completed the fifth wave. I was looking at about 15,000. We got just above 15 right here. Now we are starting to see we've broken the 20-day moving average. Next support is around 14,000. And as I said, 14.4 is the next number. We have 14,647, and this morning is where we are trading right now. I think we are going to see NASDAQ, which has been the leader, not fall off dramatically, but it's not going to be the leader in 2024. The AI, all that excitement about AI, I think it's going to subside. We're going to start looking for companies in AI that can produce profits, not something that are going to show that, oh, it's got AI, just like we saw the .com. It's got a .com at the end of the name, so it has to go up. I think AI will come back and we'll start looking at companies that can profit from it and really make money. And that's where we're going to go to. Weekly charts again, 14,000 is support here on the 20-week moving average. Right here is again, 15,000 was the target. We just got above it. This was the projection from here. We just got there, and now we're starting to pull back. So I think long-term target still remains at 17,125 to 17.7. We are about 14, so that's about 3,000 points higher. But that could be a couple of years. This is a weekly chart going back all the way to about 2021, or even 2021, all the way back about 2 years. That's what we're seeing on this chart. But the trend remains up. I think we're going to slow down in tech, and we're going to see consumer staples, small cap, financials. Those are the ones that I would be watching now. Looking at the interest rates, we peaked right here at that 5% target that we had, came down from there. This is wave 1, wave 2, wave 3. Now we're starting to see wave 4 bounce. 4% to 4.04 is the number. We hit today 4.008. So we hit this resistance at the 20-day. We could get bounced around here a little bit because usually fourth waves go back and forth, but I still expect these rates to continue to come down to about somewhere around 3.7. That would be ideal. If we get much below these numbers right here that we saw around 3.4, then I would start getting worried that the economy is really slowing too much. and the market is expecting that rates will have to come down much faster. So if you can hold somewhere between 3.7 and 4, I think that would be ideal for the 10-year yield to watch that carefully. Crude oil, which came down in wave 1, wave 2, wave 3, we're seeing a wave 4 bounce. Again, resistance is about $76. We're at 72 and change, 72 and 3/4 this morning. Then the 200-day is around 77.75. I think we should, again, get a bounce here. We got up to about that 75 number. We came down, now we're bouncing up a little, but I still feel that we've got more lows to come. The world is awash in oil, even though we are trying to see OPEC has cut back production, but the shale oil production here in the United States is hitting new all-time highs, which is always wonderful to see. In the Dow, we're at all-time highs, or were last week. We're seeing a little bit of a pullback there. S&P, if we can get above 48.18, which I think we will after this little pullback that we're seeing. That's the crude oil chart, so I think we're going to bounce around here a little bit until we start coming, bounce around here, back and forth a little bit before we come down. And we could see 68, somewhere around 68, or maybe even lower than that in oil prices. Gold chart, we hit that 2100 nearly, got above it slightly. We're seeing this pullback here. We came back down. We're below the 20-day today. Good support is 2016. We're trading at 2041 and a half today. Major support 200-day at about 1975. Those are my views. Those are my observations here for the new year. Again, if you need to get some help on your portfolios, give us a call. Simply go to compak.com and you can set up an appointment wherever you are in the world, and we can set up a Zoom meeting. If you're close to one of the local offices, stop by, make an appointment, and we will be more than happy to sit down with you, develop a plan for you for 2024. Again, if 2023 was disappointing, you bought into the gloom and doom, got out of the market because you were worried, missed one of the best years, give us a call. We'll set up a plan, look at a long-term strategy for you, develop a financial plan for you so you can get from where you are now to where you want to go. Again, Happy New Year. Look forward to talking to you next week.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.